Hi everyone, my name is Yupeng. Today I will begin our presentation by introducing Tesla's company's overview, its financial performance, and our projections for its future cash flows. Tesla is a US-based electric vehicle and clean energy company listed on Nasdaq under the ticker symbol TSLA. Under the leadership of Elon Musk, Tesla is well known for its electric vehicles such as Model 3, Model Y, Model S, and Model X. In addition, the company has developed its energy segments, which includes solar panels, battery packs, and energy storage systems. Tesla was founded in 2003 by Martin Eberhard and Mark Tarplin in California, with Elon Musk joining later as a major investor and becoming CEO in 2008. The company's mission is to accelerate the world's transition to sustainable energy. In 2024, the EV market grew by 25%, reaching 17.1 million units, and Tesla remained a global leader by delivering 1.79 million vehicles, despite a slight decrease from the last year. Tesla's financial strategy focuses on reinvesting earnings into R&D, capital expenditure, and innovation. In 2024, Tesla's capex reached $11.34 billion, with major investments in AI systems and robotics, including the Dojo supercomputer and the Optimus humanoid robot. For our 5-year cash flow projection, we made several conservative assumptions. Net income is expected to grow gradually, starting at 8% in 2025 and decreasing to 4% by 2029. Operating cash flow is estimated by applying a historical multiplier of 1.38 to net income, reflecting Tesla's strong ability to convert profit into cash. Capex is projected to increase 5% annually, and financing cash flow are expected to decrease steadily as the company reduces reliance on external debt. Despite global economic uncertainties such as inflation and interest rate pressure, Tesla is well positioned to maintain stable growth thanks to government subsidies, strong innovation, and global clean energy demand. Positive net cash flows are expected each year, ranging from $2.76 billion in 2025 to $2.24 billion in 2029. Now I will pass it over to my group member, Yingxin.
Hi everyone, my name is Yixin. I will talk about Tesla's capital budgeting analysis. To begin with, according to Tesla's 2024 annual report, the total cash flow from investing activities was $18.79 billion, of which $11.34 billion was capital expenditure specifically allocated to AI-related development, factory expansion, and advanced manufacturing. We consider the robotaxi project as the main focus of capital budgeting. Based on the assumption that Tesla will adopt financial leasing, we apply a discount rate of 4.7% over the period of 2025 to 2030. We also use Tesla's past revenue growth to estimate future cash flows. Between 2021 and 2024, its average annual revenue growth rate was 35% as in Table 1. So for a conservative projection, we apply the same growth rate to the robotaxi's expected revenues. Now please refer to Table 2. We start with an initial capital expenditure of $11.34 billion in 2025. For 2026, we assume Tesla sells 2.1 million units at a net profit of 1,000 per unit, which results in $2.1 billion in cash inflows. This amount increased by 35% each year, reaching $6.98 billion in 2030. When discounted back at 4.7%, the present value of all future cash flows from 2026 to 2030 adds up to $17.77 billion. Subtracting the initial outlay, the NPV is $6.43 billion, which is a strong positive signal, suggesting that the project is financially viable. Now let's look at Table 3. It shows how long it takes for the project to recover the initial investment in today's dollars. In year 1, only $2.1 billion is recovered in present value terms, and by the end of year 3, the cumulative cash flows are still negative. However, in year 4, the cumulative discounted inflows surpass the initial outlay, reaching $2.59 billion above break-even. Lastly, as we can see, Table 4 summarizes our capital budgeting metrics, and the profitability index is 1.57, which is significantly greater than 1, indicating the project generates more value than it costs. Based on all these measures, the robotaxi project appears to be profitable, strategically aligned with Tesla's innovation goals, and financially sound. Now I will hand over to Bingze to discuss Tesla's capital structure and provide further financial analysis.
Hello everyone, my name is Bingze Zhong. Let's start with section 4.2, cost of debt and cost of equity. To calculate the cost of debt, we use the company's total interest expense and outstanding debt. In 2024, Tesla reported $350 million in interest expense and $7,878 million in total debt. This gives us a pre-tax cost of debt of the percent of 4.44. After adjusting for tax using the company's tax rate of the percent of 20.43, the after-tax cost of the debt becomes the percent of 3.53. For the cost of equity, we use the computer asset pricing model. The formula is here. The risk-free rate is a percent of 4.46. Tesla's debt is 2.43, and the market risk premium is a percent of 5.5. Use this data, the cost of equity is calculated to be the percent of 70.83. Now, using these inputs, we calculate the weighted average cost of the capital WACC, which is shown in Table 5. This relatively high WACC reflects Tesla's heavy reliance on equity financing. Next, section 4.3, optimal capital structure. Companies can lower their WACC by increasing debt to moderate levels. Taking advantage of taking shares, the optimal debt ratio to minimize WACC is usually between the percent of 30 and the percent of 35. Currently, Tesla's debt to equity ratio is only the percent of 10.8, showing a conservative approach. While this ensures financial stability, Tesla could consider it mostly increasing its debt to improve efficiency, following our calculation and recommendations. Tesla shows strong financials and constant revenue growth with its ongoing investments in EVs, AI, and Android. Tesla is well positioned for the future. We recommend first, protect investment in AI and enjoy strength for long-term growth. Second, maintaining a convertible capital structure with some selective debt financial. Third, independent production in cost-effective regions to reduce geopolitical risk. Fourth, strengthen vertical integration in the battery supply chain to reduce material cost volatility. This step can help Tesla boost innovation, manage financial risks, and support long-term profitability. Thanks for your listening.